Income Tax 2020, Itemized Deductions, Casualty, and Theft Losses. Come in, relax with Income Tax 2020. Itemized Deductions, Casualty, and Theft Losses. With regards to our income tax equation, we're going to be down here in the below-the-line deductions, remembering that we can think of our income tax equation as basically having two halves, the top half then being a modified income statement, the bottom half the calculation of the actual tax, then application of payments and credits to get down to the amount that is due or the amount of the refund. We're going to be up top on the modified income statement section. We're comparing and contrasting the above the line and the below the line deductions. The above the line being the adjustments to income, could be called adjustments or deductions for AGI or Schedule 1 deductions and so on. The below the line deductions will be either the greater of the standard deduction or the itemized deductions. We here focusing in on the itemized deductions. The itemized deductions only being taken, or you would only want to take them if they're greater than the standard deduction. The standard deduction then being based on the filing status. It will change with filing status such as single, married, filing joint, and so on and so forth. Here's our Form 1040. We put the whole thing on one page just so we could see it in context. So we're down here on line 12. We're considering the standard deduction or itemized deduction, focusing in on the itemized deductions here. And then this is going to be the Schedule A, the component of the Schedule A that we're going to be focusing in on. We won't spend as much time on it here because it's been severely limited, but we want to point it out, and we also want to just note that it was expanded in the past. So you might have questions about basically theft and losses and whatnot that may have been deductible at one time, but there was a change in the law a couple years ago. It might change again next year, but at this point, it's been severely limited at this point in time. You might also have someone just looking at the form for the Schedule A and asking you about it, and you're going to say, yeah, it was more expanded before, but it's limited at this point. So we have casualty and theft losses, 15. Casualty and theft losses from a federally declared disaster other than net qualified disaster losses, and we would then have to attach Form 4684 and enter the amount from line 18 of that form, so we could see instructions related to that. Now note that although the 2020 Schedule A is out, and we're going to be looking at Schedule A when we look at our example problems for 2020 forms, the 2020 instructions are not out yet for the Schedule A. So the information below, we're going to get into a little bit more detail. It will basically be based on the 2019 instructions. We'll make adjustments where applicable, but just note that if you have a question about it, and you're in like a gray area on it, then you want to go to the instructions for the 2020 form if you're working in 2020 and when they're out, and we might put an attachment to them, but they should be available on the IRS website, so you can look them up at the IRS website. That's where I would start the research and then go from there for it. So you'd want to look at the itemized deductions Schedule A on the IRS website, irs.gov, irs.gov. Also note that we have the instructions for the Form 4684 as well. Once again, the 2020 instructions are not currently out, so these are basically based on and possibly modified from the 2019 instructions. But again, if you have questions about it or a gray area on it, you want to take a look at the 2020 instructions, which can be found on the IRS website. Casualty and theft losses. Personal casualty and theft losses of an individual sustained in a tax year beginning after 2017 are deductible only to the extent they're attributable to a federally declared disaster. So that's one of the big changes that were made in 2017, needs to be attributable to a federally declared disaster. An exception to the rule above, limiting the personal casualty and theft loss deduction to losses attributable to a federally declared disaster, applies if you have personal casualty gains for the tax year. So possibly if you have gains for the tax year, you can net them out. In this case, you will reduce your personal casualty gains by entity casualty losses not attributable to a federally declared disaster. Any excess gain is used to reduce losses from a federally declared disaster. Definitions: federal casualty loss. A federal casualty loss is an individual's casualty or theft loss of personal use property that is attributable to a federally declared disaster. The casualty loss must occur in a state receiving a federal disaster declaration. If you suffered a federal casualty loss you are eligible to claim a casualty loss deduction. If you suffered a casualty or theft loss of personal use property that was not attributable to a federally declared disaster, it is not a federal casualty loss, and you may not claim a casualty loss deduction unless the exception applies. See the citation under losses you can deduct later. So disaster loss, definition disaster loss. A disaster loss is a loss that is attributable to a federally declared disaster and that occurs in an area eligible for assistance pursuant to the presidential declaration. The disaster loss must occur in a county eligible for public or individual assistance or both. Disaster losses are not limited to individual personal use property and may be claimed for individual business or income producing property and by corporations, S corporations, and partnerships. If you suffered a disaster loss, you are eligible to claim a casualty loss deduction and to elect to claim the loss in the preceding tax year. See disaster loss later. Then we have the qualified disaster loss. A qualified disaster loss is an individual's casualty or theft loss of personal use property that is attributable to a major disaster declared by the President under Section 401 of the Stafford Act in 2016, as well as from Hurricane Harvey, Tropical Storm Harvey, Hurricane Irma, Hurricane Maria, or the 2017 California wildfires. If you suffered a qualified disaster loss, you are eligible to claim a casualty loss deduction to elect to claim the loss in the preceding tax year and to deduct the loss without itemizing other deductions on Schedule A. So obviously in 2020, we have different occurrences that happened in 2020 that may be something that could qualify for some kind of disaster relief. You would want to note that particular situation and then do the research on that particular situation to see the qualifications and possible deductions related to it. Losses you can deduct. For tax years 2018 through 2025, if you are an individual, losses of personal use property from fire, storm, shipwreck, or other casualty or theft are deductible only if the loss is attributable to a federally declared disaster, federal casualty loss. You can see publication 547 for more information there. If the event causing you to suffer a personal casualty loss occurred before January 1st, 2018, but the casualty loss was not sustained until January 1st, 2018 or later, the casualty loss is not deductible. See when to deduct a loss later for more information. If your property is covered by insurance and your loss is otherwise deductible, you should file a timely insurance claim for reimbursement of your loss. If you don't file a timely insurance claim, you can't deduct the full unrecovered amount as a casualty loss or theft loss, and only the part of the loss that isn't covered by your insurance policy is deductible. So obviously, if you get reimbursed by insurance for the loss that happened, then you're not going to be able to deduct it because there was a reimbursement for the loss. Related expenses. The related expenses you have due to casualty or theft, such as expense for the treatment of personal injuries or for the rental car, aren't deductible as casualty or theft losses. Costs for protecting against future casualties aren't deductible but should be capitalized as permanent improvements. So obviously, if you do something to stop something in the future, if there's a hurricane and now you're doing something for hurricane prevention in the future, then you might have a depreciable item if it was like a business property. So an example would be the cost to levy to stop flooding. Then it might be included in capital. And if it was on the home, then you might include it in the cost basically of the property of the home. And then when you sell the home, that's when you might get a benefit from it. Losses you cannot deduct. Money or property misplaced or lost. So these are like normal kind of losses. So people see casualty or theft losses, and this is the kind of questions that we'll typically have. And again, some of them might have been deductible in the past, but due to the changes in a couple of years ago would not, which again is probably good from our standpoint, from tax preparation standpoint, because there's a kind of a gray area if you're going to be able to deduct just losses in general, because then there's a question of what is the loss, what's the value of the loss, and all that gets kind of confusing, gets complicated in the code. So money or property misplaced or lost, breakage of china, glassware, furniture, and similar items under normal conditions, progressive damage to property, building, clothes, trees, etc. caused by termites, moths, other insects or disease. You can see publication 547 for more information there. A decline in market value of stock caused by disclosure of accounting or other illegal misconduct by the officers or directors of the corporations that issued the stock that was acquired on the open market for investment. So you can see how people would say, well, that's it's not fair. That wasn't fair. I should get a tax break on it. All these things were not fair, But again, that not usually qualifying a deduction there if it's not fair, But you may be able to deduct it as a capital loss on Schedule D. Obviously, if you have a loss on stocks that you sold at a loss, then the loss would be possibly deductible against other income on the Schedule D, but it wouldn't be like a casualty loss. So if the stock is sold or exchanged or becomes completely worthless, you can see Chapter 4, Publication 550 for information there. When to deduct a loss. Generally, you can deduct the part of your casualty or theft loss that isn't reimbursable in the tax year the casualty occurred or the theft was discovered. However, a disaster loss and a loss from deposits in insolvent or bankrupt financial institutions may be treated differently. See disaster losses and special treatment for losses on deposits in insolvent or bankrupt financial institutions later. If in the year of the casualty there is a claim for reimbursement with a reasonable prospect of recovery, so now you got a casualty loss, you're looking for reimbursement for it, and you can reasonably expect that you will receive it, the loss is not sustained until you know the reasonable casualty whether such reimbursements will be received. So they're basically saying you might need to delay it until you see whether or not you're going to get reimbursed, because we don't really know what the casualty loss is until the reimbursement happens, or doesn't happen, whatever the case may be. If you aren't sure whether part of your casualty or theft loss will be reimbursed, don't deduct that part until the tax year when you become reasonably certain that it won't be reimbursed. This later tax year is when your loss is sustained. So they're basically trying to avoid here the misfiling or claiming a loss that you later got reimbursed for, in which case you'd have to amend the tax return or something because you got reimbursed for it at that point. If you reimbursed for a loss you deducted in an earlier year, include the reimbursement in your income in the year you receive it, but only to the extent the deduction reduced your tax in an earlier year. So if you got a deduction in the prior year and then you got reimbursed in the later year, then the question is, well, should I go back and amend my prior year return because now I got reimbursed for some of the deductions that I took in the prior year? And they're saying, well, maybe you don't have to do that. Maybe you can include it in income in the current year. So you got a deduction you shouldn't have gotten the prior year because you had a loss, but then you got reimbursed for it. And then in the current year, you might include the income for the reimbursement that you got that you claimed as a deduction. It's not really income in the sense that it's a reimbursement. So it's not like it's income, but because you got a deduction for it last time, instead of removing the deduction in the prior year, possibly you can record it as income in the current year so that for taxes it would basically wash out over the 2-year time period. So disaster loss. A disaster loss is a loss that occurred in an area determined by the President of the United States to warrant federal disaster assistance and that is attributable to a federally declared disaster. It includes a major disaster or emergency declaration. To determine the amount to deduct for disaster loss, you must take into account as reimbursements any benefits you received for which you have a reasonable possibility of receiving from federal or state programs to restore your property. Disaster year. The disaster year is the tax year in which you sustained the loss attributable to the federally declared disaster. Generally, a disaster loss is sustained in the year the disaster occurred. However, a disaster loss also may be sustained in the year after the disaster occurred. For example, if a claim of reimbursement exists for which there is a reasonable prospect of recovery, no part of the loss for which reimbursement may be received is sustained until it can be ascertained with reasonable certainty whether you will be reimbursed. So same kind of item there in terms of the reimbursement. They're trying to say, hey, look, if you think you're going to be reimbursed, then possibly you wait till the following year to see when that washes out so that you won't have that confusion of not knowing how much to deduct because you don't know how much you're going to be reimbursed on it.